Welcome back, everyone, to the Know Your Dough Show, your favorite FDIC-inspired show for everything finance. Today, we're going to be talking about picking your banking partner.
Specifically, we're going to talk to you about why you should keep your money in a bank, different financial institutions and using federally insured financial institutions, and the differences between a checking and savings account.
First off, there's several reasons why you'd rather have your money in a bank than, for example, under your mattress. Now, this isn't the 1920s. The banks actually do keep your money safe now. For example, if you keep your money under your mattress, someone might rob your house and there goes your entire life savings and you're stuck living homeless for the next 30 years. But, let's say you keep your money in a bank. Unless there's a bank robbery, that money's not going anywhere, especially considering the fact that it's insured. What's important about banks is you can also earn a thing called interest, which we spoke about in an earlier episode. While bank interest is now at such an abysmal rate, it might as well be zero, it is still interest nonetheless to consider. So you have a large enough sum of money, you will actually make a decent amount of money off that interest. Starting at age 18, you can actually open a bank account without a cosigner, but even now you can make a bank account with a cosigner, such as a parent or guardian, and just get started in having savings.
There are several financial institutions that you can choose to put your money in. You can choose to work with a bank, a thrifter, or a credit union. What is the difference between these institutions, you may wonder? A bank is a state or federally chartered for-profit institution that offers commercial and consumer loans and other financial services. Meanwhile, a thrift can make loans, offers checking and savings accounts, accepts deposits, and provides other financial services, but it's different from a bank because they're often smaller and will have a limited product set. For example, a thrift may offer limited foreign exchange or insurance services. However, thrifts usually pay a higher interest rate on savings than banks. Lastly, a credit union is a state or federally chartered not-for-profit institution that provides financial services to their member owners who have met specific employment, residence, or other eligibility requirements.
So there's actually a lot of benefits to using banks and credit unions that are officially secured. For example, with most reputable banks at least, they are a thing called FDIC insured. This means up to $250,000 in your bank account is 100% guaranteed by the government to be there. So in the case a bank collapses, you'll still have that money paid back to you by the government, which was previously not an actual safety net that existed. So for example, in the Great Depression in the 30s, many people lost their money once the banks collapsed, and this was actually made to keep people's money in the bank so they don't withdraw it when they feel like there's a bad economy. The same thing applies for the NCUA, or National Credit Union Administration. So the NCUA is the same thing, but for federal credit unions, it also ensures that your money is safe at least to a certain portion. And some people complain that, $250,000, for example, is not enough if you have a savings account with a bank, which to I say, you can open multiple accounts with the same bank, and it's $250,000 per account. So in theory, you can have as much money in the world that is yours secured by the government.
But wait, what exactly is the difference between a checking and a savings account?
I'm so glad you asked that. Well, simply put, a checking account is meant for easier access to everyday Monday transactions. For example, if you want to use your debit card to pay for a meal, or if you want to withdraw from the ATM, I recommend you use your checking account. With a savings account, it's supposed to build up interest over time and be accessed less. And what this means is you can actually have certain charges from when you withdraw or use just spending your savings account too often per month. Some banks will actually give you a penalty. So it's important to know how much of this money am I going to be spending regularly. Most likely you want to put your actual normal income into your checkings account and then put from the checkings account the amount you want to save into your savings account. Thank you everyone so much for watching our video today on banks. I hope y'all like, comment, subscribe, and please interact with us. We're always looking for more interaction. This has been Landon
And Ava.
and we're here to make sure that you know your dough.